I often have clients ask me about buying a rental property and what kind of tax benefits will come from that. Now, unfortunately, buying a rental property that's, say, a long-term rental, one that has people that will rent for over a week, usually a long-term rental is people are renting month to month or they're on a year-long lease, there's generally not a whole lot of tax benefits that come with that type of a rental property. The reason for that is that those are considered to be a passive activity, which means that losses generated from a passive activity can only offset income from a passive activity. So let's say you buy a rental property. It generates a $10,000 loss once you factor in depreciation and other expenses that you have with it. So that creates a $10,000 loss. Now that loss cannot offset, say, W-2 income or interest income or capital gain income, because all those types of income are in different buckets. The rental loss is considered a passive loss. Your W-2 income is considered active income. Interest income is considered portfolio income, as well as dividend income is portfolio income, and capital gain income is also portfolio income as well. They're all in these different buckets and they can't kind of be mixed together. And so this rental loss ends up being what's called suspended. It sits on your return as a passive activity loss, and it carries forward from year to year, and it can offset future passive income. So let's say that rental property in a future year generates income. Well, then those passive loss carryovers can be used to offset that passive income that you have in the future. Also, if you were to sell the rental property, that would free up those passive losses and allow you to take those losses, which would then help to offset either like the gain on the sale of that property, or if it completely offset the gain, maybe you had a loss on that, then it could offset like W-2 income or other types of income on your return. But generally, a long-term rental like that does not generate tax benefits of its own. The benefit of owning a long-term rental is that it will appreciate over time. You'll be able to depreciate the home itself and get some tax deductions and benefits that way. You'll be able to deduct the interest on any mortgage and things like that. Now, to get a tax benefit for owning a rental property, there is the kind of what we would call, I guess, the short-term rental loophole or the short-term rental exception. And that is that a rental that is on average 7 days or less is considered to be a short-term rental and falls into a different category. It's no longer considered to be a passive activity. It could be considered an active activity as long as you actively participate in it, and there's several requirements for active participation, the hardest of which is you'd participate in that activity 750 hours during the year. There's also a 100-hour participation activity. If you participate 100 hours in it and you have more participation than anybody else in that, then that would qualify. And there's several other types of material participation that you'd want to have with that. And we can get into more details on that in another video. But if you meet the material participation, if you have the rental activity that's 7 days or less on average, then you could take any losses that come from that and offset W-2 income, interest income, dividend income, capital gain income. It can offset any other type of income on your tax return. Now, in order for that to be considered an average, then you would need to rent it, say, like at least 2 or 3 times, ideally 3 times before the end of the year. So a lot of times clients are at the end of the year saying, hey, I need to save money on taxes. What happens if I go out and buy a rental? And that could be the case if you've got time to go out, close on a rental property, buy it, and then have it rented, say 2 to 3 times at least by the end of the year, and have those rental periods be under 7 days, then that establishes that the average rental period of that property is less than 7 days. It makes it a short-term rental. Then if you generate a loss from it, you can recognize the loss from that. The real benefit in that short-term rental and recognizing a loss is doing what's called a cost segregation study. And we have another video that goes into detail on cost segregation studies. But basically, a cost segregation looks at a building. Like here, I'm in a commercial building here in my office. And this building, being a commercial building, would be depreciated over 39 years. However, there are components of this building that won't last for 39 years. Like you can't see the flooring, but it's carpeted here. That carpeting is not going to last 39 years. So carpeting is depreciated over a 5-year life. There's fixtures and other things in this building that would be depreciated over, say, a 5-year or a 7-year or a 15-year life. The tax code allows you to break down the building by those components and depreciate certain components faster than other components. And that's what a cost segregation study does. So the year that you buy this rental property, you could do all the material participation. Let's say that it takes a lot of time to go and buy it. It takes time to go in and maybe do some rehab of it, some remodeling of it. You're going to want to decorate it. You're going to put a lot of time into it. So that first year, it's pretty likely you're going to hit the material participation rules just by all the work that you have to put in getting that property ready to rent. Then once you get it rented, again, do it 2 or 3 times before the end of the year, then now you've established that it's an under 7-day rental. It's a short-term rental. You could then do that cost segregation study, which will generate even more deductions. Cost segregation studies sometimes you can get up to like 20 to 30% of the purchase price as a deduction. So it could generate a pretty significant loss that first year and then give you that great benefit. So you'd get a huge tax benefit the first year you owned it. Then going forward, all you have to do is have the material participation for that first year to take the cost segregation study. And then going forward, you don't have to have that material participation as much unless that's continually generating a loss that you want to take on your return. But then going forward, you wouldn't have to worry about that as much. So you get this great benefit the first year, and then you've got a nice property that you own going forward that will appreciate, that you can sell, and you've got an asset that you're holding. And so that's how the short-term rental kind of loophole works, and why it's better than the long-term, because long-term can fall into passive, short-term might not. So if you're looking for other tax tips or ways to save money on taxes, make sure to subscribe to our channel below. And we send out a weekly newsletter. If you go to taxtutor.com, you can subscribe there.